Some perspective. We have Mark Giannoni, he's Chief U.S. Economist at Barclays. He's with us in the program. Mark, great to have you with us here. Thank you for your time. It looks like all those sort of fears about a U.S. recession, etc., are behind. And last week we had that once again that so-called Goldilocks kind of data, which the market has latched on to. And if you look at U.S. stocks, it does seem like we're not in the phase of short covering anymore. There are fresh longs being added. So you're in once again. Would you agree in a bit of a risk-on kind of a zone? What's the perspective, Mark?
Yes, again, thanks for having me, and good morning, happy birthday. So last week's retail sales, I think, have been quite important. They suggest really that the spending part of the dynamic that has been driving the economy, and in particular the cycle between employment, the income that gets distributed, and then the household spending. That cycle keeps going. And there were some concerns a couple of weeks ago when the payroll report came out that was about to break. We didn't think so. We thought that the fundamentals really for the households in the U.S. economy are still strong. If you look at income, if you look at household net worth, and that the economy can continue to power through.
Mark, hi. Good morning. So, just about 2 weeks back, everyone was fretting about a hard landing in the U.S. And now data is looking like, maybe it won't be that bad. What is the extent of rate cuts that you're penciling in from the Federal Reserve, and the way you see risk assets respond to the current macro setup?
Yes, so on the Fed, our expectation is for the Fed to see that there is some slowing taking place. The economy is no longer growing as rapidly as it was in the second half of last year, necessarily at the beginning of this year as well, that we see the labor market gradually cool. And with that, inflation has also come down. And it has come down to a point where the Fed is comfortable now about starting to cut rate. Our expectation is that the Fed will cut 3 times 25 basis points this year, first in September, then another 25 basis point cut in November, and then a third basis point cut, 25 basis point cut in December as well. So that's our expectation for this year. As far as equities are concerned, they'll benefit from a slightly lower rate, and they benefit from that. They also benefit from a pretty resilient growth. So going forward, we expect the economy to remain resilient, to not enter into a recession, but to really gradually slow to the long run steady state growth path that the Fed has been trying to engineer, and the soft landing it has tried to engineer. So we are pretty optimistic on that.
Right, 3 rate cuts with a soft landing, positive for equities. But, before the Fed meet, the near-term imponderable will be what we hear from the Jackson Hole Symposium. What are your expectations from there? What is it that you think Jay Powell would say or should say?
Right. So we think that the Jay Powell will give an important speech on Friday here, 10 Eastern Standard Time, Friday morning. Our expectation is that he will express more confidence that conditions are really in place for a 25 basis point cut at the September meeting, provided still that inflation remains moderate and the labor market conditions remain unchanged. We strongly doubt he will make any policy commitment, like we think he will likely reiterate that decisions are going to be data dependent. They are also going to be made on a meeting by meeting basis. But we also think that Powell will mention that the FOMC is prepared to respond forcefully if the labor market were to unexpectedly weaken. So our expectation again is baseline scenario, he's going to open the door for this 25 basis point cut. He'll express confidence about that, but be open to the possibility of having to cut more if conditions were to really unexpectedly weaken.
All right, Mark, we'll leave it there. Thank you very much for your time here on CNBC TV 18. Thanks for the wishes earlier. Appreciate you joining us here this morning. Well, that's Barclays with a perspective, so no recession. I mean, I think that is a thing in the past. We're back to talking about as we were from the middle of last week, Goldilocks.